Good morning and good afternoon, everybody. Thank you for joining this webinar put on by SFRhub Advisors, Rcm Capital, Marketplace Homes, Real Protect, and Stewart Title, talking about a really big topic within the single-family rental industry right now, both comparing your traditional single-family rentals and your build-for-rent rental opportunities. So I am Mike Tamalevich from Marketplace Homes. We are a national third-party property management group and asset management group managing approximately 5,000 doors across 39 or so different states, with a good mix of retail investors as well as institutional clientele. And I wanted to go around and obviously give an introduction to everybody who is joining us today on the panel. So first up from Rcm Capital, Alan Johnson. Alan, why don't you give us a little background on yourself and the company?
I'd be muted, Alan.
Alan, are you muted?
Sorry about that. Yes, I was. Alan Johnson, Director of Origination for Rcm Capital. Rcm Capital is a nationwide lender for residential investment properties, focusing primarily on 1 to 4 family, whether it be single asset, portfolio lending, fix and flip. So we're here to help with all your lending needs in this area.
Fantastic. Next up, Michael Finch from SVN and SFRhub Advisors.
Thank you, Mike. Michael Finch here. I'm a principal founder and executive vice president of SVN SFRhub Advisors. As Mike just mentioned, I'm also principal founder of SFRhub.com, which is our data and valuation company that powers our advisors' commercial brokerage. We are 100% focused on all things single family portfolio investing and new construction build for rent investing that we'll be talking about here today. So I appreciate everybody joining and looking forward to the conversation. Thank you.
Thank you, Michael. Next up from Real Protect, Lee Rogers.
Hey, good afternoon, everyone, and thank you, Mike. Appreciate the opportunity to participate in the panel today. Real Protect is a national insurance broker that works exclusively with residential real estate investors. We insure properties in all 50 states, have clients in about 15 different countries, and work with a number of lenders, property managers, marketplaces, and investor groups across the country to provide insurance solutions for the single family rental market. And we, again, appreciate the opportunity to be here and participate.
Thanks, Lee. Next up, Troy Evans from Marketplace Homes. Troy, hopefully I didn't steal too much thunder about the company, so you probably do this a little bit better than me. So go for it.
It makes me have to say a few bullet points less. But like Mike said, my name is Troy. I run our retail investor business development and property management sales here at Marketplace Homes. A little bit on top of what Mike said, we operate in about 42 states and can do everything from post-acquisition rehab to leasing up and ongoing property management from multiple different facets, and you can customize what our investors need in all of those markets, whether it's built for rent or it is a single family rental from 1 to any number of thousands of homes.
Thank you, Troy. And finally, from Stewart Title, Ted Jones.
Greetings, Ted Jones. I've been chief economist for Stewart for 24 years. Before that, I was chief economist at Real Estate Center at Texas A&M. I'm a commercial appraisal guy, and you're dealing with one of the most explosive growth markets in the country. Think about that. Single family rentals became the new commercial class of real estate in the last downturn. And it grew even more under this downturn than it could ever be imagined, and it's poised to do the same. We at Stewart Title are pleased to close your transactions any place in the country and 22 foreign countries if you want.
Thanks, Ted. You know, it's funny, Ted. I remember sitting on a panel with you, probably 2 or 3 years ago, and I don't think we had met prior to that. And I turned to somebody after, and I'm like, that guy knows a lot of stuff. You got your finger on the pulse of a lot of things. So that's a great introduction. You know, something that I know a lot of us have tried to do when we're doing these is to throw up some poll questions during the presentation, just so that you know, we're able to get some idea of who the audience is, what they're looking for, and it helps frame some of the questions and answers that we can put in front. So the first poll question that's going to be going up is to self-identify your profession. Basically, where do you stand within the industry? So when that pops up, go ahead and make your selection. You know, obviously, developer, investor, broker, property manager. I feel like everybody on this call probably checks at least 3 of those, which is really exciting. You know, to be able to get some content from people that are living in the weeds, as they say. You know, with all the different things going on. All right, fantastic. Well, you know, first thing we wanted to jump into was really getting a high level primer of SFR as it compares really to build for rent. So Michael, why don't you give us kind of a quick minute or two of some of the differences and what you're seeing out there.
Sure. No, thank you. So when we talk about SFR, specifically here at SFRhub Advisors, because we're a portfolio investment space, you know, we're talking about single family rental portfolios or single family rental properties. So since we're a commercial brokerage, we keep it at a minimum of 5, just to stay out of the residential sort of zip forms and rules and regs that different states have. So if we keep it at 5 or more in a single family portfolio, we stay in the commercial world. But SFR is just single family rental homes. So that can be like you guys at Marketplace, you might manage 1 home for an investor, or you might manage 1,000 homes for one investor, and everything in between. For us, we broker those types of deals, across 5 or more. And then in build for rent, that's all new construction, single family homes. Those can be detached homes, that can be attached townhome product, it can be duplex product, but we're talking about homes that are on fee simple lots. So I draw a differentiation between, there is some confusion out there between the horizontal build for rent, which is, smaller cottage style units, like 1 bedroom, 2 bedroom, maybe some 3 bedroom units that are between 600 square foot and maybe 1,100 square feet on the larger end. But they might put 175 of those on 1 parcel of land. So when we talk about build for rent, we're referring to true fee simple homes within a whole subdivision, or it could be a portion of a subdivision, or in certain states, specifically in like Southwest Florida, where there's a lot of scattered lots, you could do a new construction build for rent portfolio that's scattered around. Of course, all these build for rent deals, once they're built and leased, they do become SFR portfolios because they're now existing and operating as such. But we do notice some efficiencies that can be had when you purchase a whole community of homes that are built for rent, as opposed to the scattered home portfolios. Though thanks to groups like Marketplace Homes, the efficiencies have been proven and well proven in the SFR for operating those scattered home portfolios. So we're seeing a lot of new commercial investors coming into the space now, recognizing that it is not that challenging to operate a scattered home portfolio like was thought of 15 or 20 years ago when they compare it to a multifamily deal. But so really the distinction is either new construction that you're building and renting, or existing homes that are already rented. That's a big difference between SFR and BFR portfolios.
Gotcha. That's great. I'm sure that's very helpful for a lot of the people that are listening in, just getting an understanding, because really at the end of the day, it's like SFR is kind of like your industry, right? And then you have all these subcategories of different product, that can all roll up to SFR at the end of the day.
Build for rent certainly new. So, we do a lot of consulting with developers and builders on how to properly optimize cash flow, and buyers on how to properly optimize cash flow, to think about the design, think about the floor plan and unit mix. So, we're happy to help in those situations. We've been doing it for years, and we have an extensive development and construction background under the roof, but we're much more than a brokerage. So we can certainly help with any of your build for rent or data and valuation needs on listing portfolios as well.
Yeah, and I can imagine that's a huge need out there right now, because I mean, builders know how to build houses. You know how to maximize the build from a rental perspective, I'm sure, with a lot of different things. Very good. I appreciate that. So Ted, why don't you take a few minutes and really look from the top down, from the MSAs that you're currently covering, this industry, this great industry of SFR that kind of has been, was born coming out of the all the housing trouble that we had now, geez, more than 10 years ago when all that started, which seems crazy, because it still feels like this industry just got started to a certain extent. But why don't you give us your market updates and your outlook on 2021 and going forward?
Thanks very much, Mike. Erica, go ahead and pop up that presentation. I'd rather see it than myself anyway. By the way, honored to be included on this. So I grew up on a sheep ranch in southwestern Colorado. Oh, and by the way, that was the champion Rambouillet Ram at the Ohio State Fair back in the 20s or 30s, something like that. Mike, I know you're going into, so kind of for you. But there's a lot of wrinkles in the U.S. housing market. Erica, hit that next slide. So you talk about, if there's one thing I can talk about markets you want to head into, they got to be growth markets. Now, that's kind of difficult with the pandemic, but not as much as you think. So my premise is that jobs are everything. And what we're learning is the biggest job growth percentage-wise is taking place in the secondary and tertiary cities. It's not the global entry cities. It's not Miami or New York or Chicago or San Francisco or LA. So what I have here, and I highlighted the portfolio that's coming up just so you can key on that. And these are hot off the numbers, hot off the press numbers. Here's job growth. Look at the red column. On my data today, I want you to look at the red column. What that is, we're going to go from February 2020, that's before the pandemic, to now. Did you know there's 15 metros across the US today that have more jobs than they had before the pandemic? 15 of them. Waco, see that 0.2% at the top of that red box? What you're going to look at, oh, by the way, I like cities for investment, and I don't care whether it's single family or anything else. I like tech. I like new manufacturing. Let me define new manufacturing. New manufacturing are cities that, like Spartanburg, they're new cities that are manufacturing, not old Rust Belt cities that are manufacturing. I love college towns. I don't think you can miss in college towns, folks, because or state capitals, because they almost never lose major jobs. They're almost always in growth modes. So I threw in some other secondary and tertiary cities here that I find kind of attractive. If you want to look at it. Oh, and it's intriguing. We have 15 cities now that have more jobs than any time in history. 4 of those are in Utah, and they're all tech oriented. And oh, by the way, Salt Lake City, 16th overall out of 380 MSAs. They're just barely negative. So you could say 5 of 5 MSAs in Utah. Hit this next one, Erica. There's my cities less than 500,000 jobs. Looks like here's more than 500,000. Oh, and again, the portfolios you're going to hear up from the people coming up talking about are in Richmond, Virginia, and Phoenix, Arizona. And I understand the one in Phoenix is already sold. I'm not surprised at all. When you look at this, they're only down 3%, since the pandemic now, and it's the biggest city on the map that we included in this data series. Again, you can see the cities that I find very attractive. And Erica's got this, and she can send the PDF to anyone that would like a copy, I'm sure. So that's all part of it. Hit the next slide, Erica. Now, this is an analysis I have. Where do I want to go in housing and where I don't want to go? And I personally own some apartment projects, B and C type apartments. So I've developed this methodology, and what I look at is I look at the total number of new dwellings that have been built. And that's 2011 and now, both single and multifamily. I look at jobs, I look at jobs or dwellings. So Erica, hit that button once. And what you're going to see is, I think you need between 1.25 to 1.5 new jobs per new dwelling unit. That means in the US, since 2011, we're anywhere, and this is total housing, both owner occupied and rental occupied, between 4.2 million and 7 million units short of what demand is. So when I tell you there's pent up demand for housing across this country, it's big, it's material. You can see that it's literally, since we in that period built less than 10 million total dwelling units, and I say we're up to 7 million short. But there's some markets that are really key. Now, if you want to do this for any other MSA in the country, just go to the real estate center at Texas A&M. They have building permits online there you can download for any MSA in the country. Erica, hit the next slide. Now, when we talk about that 4.2 million to 7 million, what we have are crowded housing markets. Hit the next one, Erica. Got to keep that sheep theme going. Y'all supposed to laugh on that one, guys. No one's laughing. Okay. Go ahead, Erica. Hit that next slide. Now, when you talk about single family, most people don't realize this. That's 2 out of every 3 dwelling units in the country. Oh, and look at the bottom 3 categories dwelling units, or the bottom 2 anyway: mobile homes, boats, RVs, and vans. I don't count those. So you have to realize how important single family is, and not everyone wants to live in single family, or the majority do, but they certainly don't have the ability to own it or don't want to go through the transaction costs. Erica, hit this next slide. So what I did is I took, again, look at the red box. I said, if we're between 4.2 and 7 million short, then, and we look at our single family permits, that means at this point in time on rentals, and I went back to the rental ratio, we have demand today for an additional 1 million single families up to 1.7 million single family units for rent. Wow. What I'm trying, and realize this last year, we didn't even sell 1 million new single family homes. We're not anywhere getting to filling this. I'm just trying to tell you the demand continues to outrun supply. Erica, hit this next one. So we're going to look at now, here's Phoenix MSA, and notice that now Phoenix, when I tell you we're short dwelling units, we're short anywhere between 75,000 and 120,000. Now look at the total in the middle. On the best year in the last 5 years, we didn't build 36,000. That means Phoenix, to me, of your 3 cities on your portfolios, to me, it was the one I loved the most. Because even if we built as many as we built anytime in the last 5 years, we can't even cover total pent-up demand for 2 years, assuming there's no additional demand. So there's Phoenix. Hit this next one. And here comes Richmond. Now, Richmond, it's not as, to me, it's not Phoenix. We'll just put it that way. I can understand why it's infill and things like that because of those projects there, but they still are short housing. They have 1.77 new jobs for a dwelling unit. And then the last one, let's go ahead and pop up Spokane. And here we're anywhere between 1,000 and almost 5,000 units short. So that gives you a quick summary of where we're at. We looked at job growth. All these fit that parameters. Hit this next slide. Let's go ahead and talk about this one real quick. Bottom line is, everyone wants their own place to stay, but not necessarily to own. 67% of all housing inventory in the U.S. is single-family dwellings. And remember, almost 7-8% are boats, vans, and other things that really don't count as housing. You and I wouldn't count as housing. Just trying to tell y'all, this remains probably the best growth industry in the United States of the commercial segments. And there are some markets better than others. And I just gave you some of the secondary and tertiary cities I like, and I like those better than most big cities. To tell you, Phoenix is where it's at and where it's happening. With that, I've wrapped it up, guys. Any questions?
Ted, I quick question for you. Your economist point of view with where we're at today, where home sales are at today, where prices are rising, and everybody's talking about the inflationary concerns. What do you see happening, and how is that going to affect the for sale market and the for rent market in the next 6 to 12 months?
So right now we have a large number of cities because of, now prices have gone up a bunch. It went up 19.1%. Median home price of existing home sales this April compared to a year ago. And rents haven't gone up that much. But where we're sitting right now is we have a large number of cities because of low rates that are still preferential to owning. As rates rise, and they're going to rise, I want you to name me one thing that costs less today than a year ago. Can you name one thing that costs less than a year ago? I don't think you can do that. In fact, I wanted to do on my Twitter account, say name 3 things, but I couldn't think of one thing. And so as prices rise, then what we're going to be looking at is that switch is going to go from ownership in many metros, not all of them, into renter preference. And you're going to see that because as home values, they've gone up now, as inflation kicks in, home values won't go up as much, but rents will go up more. And so I love in the position where rentals are at today in an inflationary environment, as long as you have job growth, that your rentals are going to do a lot better perhaps than they otherwise would have. So I'm like I say, I'm walking that talk when it comes to rentals.
I think we all are.
That's why we're here, right, Michael?
Mhm.
Troy, just to touch on what Ted just said, I know something we talk about a fair amount is the increases in rent that we're able to get. Have you started to see those shift a bit as far as compared to 1, 2, or 3 years ago when somebody's renewing their lease, how much of a jump you're seeing in the rent?
Yeah, I really have, and the conversation is coming up a lot with our individual owners, especially, is how can I make this worth my time if I don't sell it? Because we are at a point where the equity that they're having in these units just makes sense for them to liquidate it. The demand from a retail investor, institutional investor point of view is so high that they know they can get a premium on their assets. So how are they able to maybe continue getting that upward trend for as long as it may last there, Ted, and make the rental still worth it? And where it's surprising me the most are areas where you would think of low income housing, areas like Detroit, for example. Some duplexes there, you're starting to see the rents go up, you're starting to see Section 8 vouchers go up, and those are becoming even more prevalent as people can't compete for those rentals that they used to be able to afford, for $400 to $600 2 years ago. And where these investors who are buying these, what they used to call the $1 homes in Detroit, who are putting a lot of money into it, and you'd always hear those negative HBO documentaries about it, are actually starting to profit off of the need for these rentals. It's definitely a line where you're trying to make sure that the residents are staying in the homes as much as possible, in a community where their incomes aren't growing as much as the rent rates are going up, which is leading to vacancy, or more government voucher programs, or even just more sales at the end of the day.
Gotcha. Yeah, that makes perfect sense. All right, so moving on to our next poll question that we're going to pop up is, how many single family rental properties do you currently own? So just take a couple seconds. That should pop up here momentarily to be able to put that up so that you're able to answer.
Mike, while people are looking at that, just to add on to what Troy was saying, and really what Ted was pointing out, due to the lack of supply, I mean, the groups that we're working with that own portfolios of homes, they're operating at 97, 98% occupancies, because there's nowhere for people to go to rent. So they're really being able to push those renewals, or if the renewal doesn't want to stay, they're not having any trouble pushing new lease rates in almost every market around the country right now.
Right. Yeah, something that we've seen an uptick in is people signing leases without actually physically entering the property. A solid rental that's fairly priced to the market comes on the market, and the photos obviously tell 1,000 words about it, and people are signing leases before even walking into them. Yeah, because it's such a competitive market, even on the rental side. So we're seeing a lot of that. All right, so moving on to the portfolio section of this, Michael, I know you have 3 distinct portfolios that we were going to put up on the screen, just to kind of talk through the basics of each one of those, some of the key points that you've seen, and you can walk us through the three of those.
Yeah, I'll walk. Yeah, I'll be quick here, and then everybody can discuss how they would have been or still can be accretive to these portfolios given what everybody does here. But this is the one that sold, so not available today. This was a build for rent deal, and it wasn't in a self-contained community, but it was 20 homes built in one subdivision on the west side of Phoenix, and then 20 homes built on the east side of Phoenix in a separate subdivision. So they were a smaller portion of a larger subdivision. But this just, like you had mentioned, Ted, this just went off the charts. We took it out to market, and within, I would say, 10 days had about 9 offers on it. We eventually drove it above asking price. It was all new construction homes. They were leased under market, so there was immediate economic value add for the investor. And then you add on top of that, I mean, we couldn't even perform the rents as fast as the rents have been growing in Phoenix. So there's been further economic value add on pushing those rents since the buyer bought it, I'm sure. But they bought it at a sub 5 cap because there was opportunity to immediately start turning those leases and or renewing at higher lease rates. And it was a great buy for the buyer. There was a ton of interest, and it was a unique portfolio here in the Phoenix metro area because there haven't been a lot of new construction. This is really more of an SFR, even though it was new construction homes, but since they were scattered around 2 different subdivisions, they weren't contiguous to each other, but mixed in with a for sale neighborhood. It gained a ton of traction from most of the known buyers and some new buyers that came to the table offering as well. So it was a really unique portfolio, and we were excited to get this one sold. And I believe it sold for just about $13 million, little less, but great deal.
Gotcha.
We can go with it here.
Yeah. Specifically, like just looking at that portfolio, Alan, from a debt perspective, if this portfolio is in front of somebody and they're taking a look at it, what are some of the key points that they need to have access to if they truly want to get a good idea of what the cost of capital would be for a transaction like this?
Yeah, so when we look at something like this, we're primarily looking at the debt service coverage ratio type of loan where we're looking at a minimum debt service coverage ratio of 1.1. We can go below that if need be a little bit, but we're really looking for just your standard tape. We want to know how it's going to debt service. FICO score comes into play, but I put this one together, and we're looking at 80% of acquisition. Rates right now are just tremendous. So everything seems to be cash flowing very, very well because rates are so low, and like everybody's been saying, rents have been so good. So, and in an area like Phoenix where we don't see the higher taxes, this cash flowed very well. So we're at 80% of acquisition. Rates were as low as 3.85 on this. There are some par pricing on it. So, with the market the way it's been going, rates doing what they're doing, we're able to do some par pricing. Investors are able to buy down those rates, just allowing for a lot of options for them to be able to just cash flow even better if they really want to hold these long term, which most people do. So they could buy these rates down to 3.85. Par pricing is still pretty good in the mid to high 5s. So this was a great portfolio. Actually, all the portfolios we're going to look at are very, very similar. Again, with just the way the market is right now, and I just feel like a way smarter person right now than I did 10 minutes ago before listening to Ted speak. Now I understand why the volume that we're getting at Rcm Capital is so high on these portfolio loans. There's just so much coming in lately. The rates are so competitive. The leverages are great. And with the rents, I mean, it really doesn't even matter where we're at in the country, you know. So it's just been a great opportunity lately for this. Probably about the last year, it really started ramping up quite a bit. So this was a great portfolio to look at. From an RCN standpoint, little risk to this. From an investor standpoint, just nothing but upside.
Gotcha. You know, Lee, I'll ask you the same question. You know, as it relates to the insurance of a portfolio like this, what are some of the things you need to see to be able to give an accurate quote on what the cost of coverage from something like this would be?
Yeah. So
so we would.
We love the insurance industry in general loves build for rent, obviously, because it's brand new product. You've got new construction, you've got new roofs, you've got great data on the systems in the house, like the heating and air, the electric, you know, everything is up to code, the plumbing. And so, you know, a couple of great things about this portfolio. Number one, it's in Phoenix, Arizona, where there's not traditionally a ton of natural disaster that occurs in Phoenix as it relates to maybe, you know, Texas, the Midwest, or, you know, along the coastal region of the Southeast. So you should have very favorable insurance costs in the Phoenix market. And Michael alluded to the fact that this one sold for around $13 million, 40 houses. That's about $325,000 a house. And I can see that they're around, you know, just under 1,800 square feet a house. And so you got a really good, a lot of times in the market, we'll see a really big disparity between the market value of a home and then maybe the replacement cost of a home. We're seeing that gap shrink a little bit now, where we're seeing replacement costs catch up. You know, this day and age, you know, as we sit here today, lumber cost and material lag times are extremely high compared to where they were, you know, a few years ago. But from an insurance perspective, you know, we love build for rent, or we love, you know, the finished product. One thing I would caution sometimes in a build for rent scenario is, and it's obviously not an issue here because you had properties that are occupied, is sometimes you would have some properties that, you know, could be sitting vacant until they become rented. In the insurance world, you know, vacant properties, our data supports this, that when you have a vacant property, you're going to have a higher instance of insurance claims. You're just going to have vandalism and theft while those properties are under construction. One thing I would caution the audience as well is, if you are doing some build for rent, understand that during construction, you're going to have a builder's risk policy in place that is going to cover the structure while it's being built. But a lot of builder's risk policies, once you've got a CO, become null and void. So you'll need to have a separate policy once the property has been turned over to you as the owner. In this situation, you know, you have a portfolio in two different subdivisions. My guess is that the purchaser didn't actually develop the properties and build these, but they purchased them from a builder or from a third party. And it sounds like they already had tenants in them. So from an insurance perspective, you know, this would be a great portfolio. You should be able to get very aggressive rates in the Phoenix market. We'd love to be a resource for that. And you know, again, build for rent is really very favorable all across the country from an insurance perspective right now.
Hey, Mike, if you don't mind me asking Lee a quick question, Lee, how would you look at, since this was all new construction and rented, and they were scattered, so it was, even though it was a build for rent, it was, you know, ended up being more of an SFR portfolio. How do you look at the difference between something like this and a whole community that's being built for rent, where all, you know, let's say 100 lots have 100 homes and they're all right there together, as opposed to being spaced apart from an insurance perspective?
Yeah, so if you do take down an entire community, and you're the developer, and ultimately you keep title to the properties, concentration of risk, and it's not as big of a deal in Phoenix as it would be, say, in Texas or Oklahoma, where you may have 100 properties that are very concentrated. So if you have a large windstorm or hailstorm that comes through, you're likely going to have a ton of insurance claims, because obviously those types of things are very localized. So when you have concentration of risk, that can sometimes be a little bit of a deterrent for certain insurance companies, because they don't want to have that many roofs or that many structures with the concentration of risk. The other thing I'll bring up, and this is a little unrelated, but if you do have an entire community, and you as an investor have developed that community and you decide to put in, say, amenities, make sure that if you've got a pool or other structures that you're properly insuring those and insuring those separately from the structures as well, because if you retain title to those, or even if you turn them over to an HOA, make sure that you follow the letter of the law, what the HOA documents say that you're supposed to do, and make sure you've got proper insurance on all of the amenities, so that in the event someone is injured in one of the amenities or you have a property loss, that you've got coverage for that as well. So there's a few more considerations in a total build for rent community than when you are just buying a certain number of lots in an already established subdivision where you're not the developer.
Thank you.
Yeah, that's a really good point. And Lee, you had brought something up about the risk of the vacant units with, everybody knows vacant units, things can happen right while that's happening. Troy, from your perspective, I know you've done a number of transactions similar to this. What have been some of the tips you would say about how to actually get to leasing efficiency on something when let's just say the builder delivers you 15 homes and they're all in the same neighborhood and you're ready to go and you want to go to lease up. What's your kind of go-to to make sure that you're getting that saturation from from lease activity?
Yeah, I would say there's two distinctive plays. One is before stabilization of the community, and I would say that's probably anywhere around 90% leased, and then before that. Depending on the number of floor plans, it's always just like any sort of new construction type, very good to have maybe a model where 30 days before they start coming online, you can start showings, on a stage model with various layouts. If there's a few different floor plans that you can give to them to maybe get a lease signed before they've even been completed. As they continue to come off the line, 3D tours have been extremely helpful for us to be able to provide the residents with, let's say there's 3 floor plans, the ability to see what they could potentially have as they're coming online. The entire idea being to have them leased before they even come online. It's definitely been a great process to have an in-person showing capacity, because not everybody is comfortable with signing a lease on something that they've only seen virtually, but also having the technology in play to give them an idea of what other properties they could be renting.
Gotcha. Yeah, that makes all good sense. Lee, just one follow-up question I had, and I get this question from a number of people. I think Troy gets this question from time to time, and it's always, everybody obviously wants the best deal for the services that they're getting. Whether Michael's brokering something or if Alan is putting a debt deal together, Troy's doing PM, you're doing insurance. What's kind of the threshold where the pricing doesn't get any better because of having more assets that you're insuring, right? I mean, we look at it from a property management standpoint, and I think once you get to 15 or 20 units, it's about as lean as we can possibly make it. From an insurance side, would that stay true, similar, at a certain level, or is it truly the more you have, the more you can kind of mitigate your risk by spreading it out across the portfolio?
Yeah, it does come down a little bit to the concentration of risk that I alluded to earlier. And scale and insurance definitely can help. However, if you've got scale in the wrong areas, then that could be actually a detriment to the portfolio. But if we have an investor with 1 or 2 properties, typically what's going to happen is we'll have a certain price structure for that. But when we start to get to 50, 100 properties, we have different conversations with the insurance providers that we use. 500 properties, more, 1,000, obviously you've got more scale, more spread of risk typically. And, as well, an investor, their insurance mindset can change a little bit as their scale increases, because they can look at higher deductibles, or they can negotiate for better terms and conditions at that point. So while price is always, usually in insurance, the deciding factor, sometimes coverage structure can play a really important part of it as well. And where we always try to start, one of the first questions we always ask is, who are you borrowing money from? Because most folks are borrowing money. And we want to make sure that we're putting in an insurance program that is supporting the lender's requirements. Because if it's not going to be compliant with Allen and RCN or any of the lenders that we work with, then it's, then we've got to go back and find a compliant insurance policy. But there is definitely some advantage to having scale in insurance as long as certain conditions are met.
Got it. Great. I appreciate that feedback. Michael, why don't we flip to the next portfolio that you had that we were going to present? There you go.
Thank you. And again, I want to thank Ted for putting those numbers together on these 3 cities. Hard to follow Phoenix in rent growth and value growth, but we got a great opportunity here in Richmond, Virginia. This particular seller has been aggregating these homes over time. He's actually built all of these, not himself, but a friend of his who's a general contractor. He would go buy the lots. They would build the homes and he would rent them. So he's been doing this since about 2004, I believe. I think about 13 out of the 16 homes are all built since 2004. Good, clean, quality opportunity. Like a lot of mom and pop investors that Mike and Troy, you guys can talk to. They aren't asset managers like the big boys, and they don't push rents as much as they could. So, like you see here, there's real value add opportunity in the economic growth of this portfolio. Richmond is a strong market. Like you saw from Ted's numbers, it still has job growth, still has value growth. We're excited about this portfolio. We just took it to market. I want to say like a week or 2 ago. We're getting a lot of interest. I think we've got maybe an LOI on it now. I'd have to check with my team. We might have 2, but it's totally available, and we would love to speak with any of you out there that are interested. And as I said, it's a nice, clean portfolio. The seller is a hands-on guy. He knows his tenants. He's rented to kind of mid-tier professionals and families. So he really takes care of these homes. He's built these homes, and he's proud of them. So, a lot of, not a ton of deferred maintenance, for homes that are somewhere between 10 to 20 years old, and would love to speak with anybody out there on this opportunity. This is a great deal in a strong market.
Absolutely. Alan, when Michael made the point of the homes being under rented, and I think we come across that a ton as well, especially when you have like the owner operator, right? That's managing it. They just want to keep the person in the property. They don't really want to deal with the vacancy whatsoever. So you see things like 10, 20% below market rent. Is there much consideration given from a lending perspective when a portfolio like this gets in front of you and you see that the rents are about, let's just say 18% below market? How does that factor into the equation?
Yeah, so this one didn't debt service as well as the one in Phoenix, but the deal still worked. Everything was great from a debt service standpoint. But to your point, when I mentioned before that we do have an opportunity to reduce that floor of 1.1 actually down to 1, and in situations like this one where it kind of makes sense from a rental standpoint. So we know that what these properties can actually collect for rent is much higher than what they're getting now. That's where we might look at making that exception to go down to a 1 debt service coverage ratio rather than a 1.1, knowing that with a new buyer, a new investor going in, these rents will most likely increase over the next year or so, and put us in a much better cash flow position.
Got it.
Or we'll just call Lee and get lower HOI premiums. Yeah,
just for for reference for the audience, because obviously I think this spans everybody from institutional to people just getting into the business. Explain DSCR requirements, because I think that all of us have been in this industry for a long time and get it, and then somebody hears that, they write it down, and then they're going to have to go Google it. So
yeah, how do I figure that out, right? So it's much simpler than it sounds, trust me. So basically, debt service coverage ratio is your rental income divided by your principal, interest, and taxes and insurance payment. That's it. So basically, when you say you want a 1.1, the rent just has to be 10% greater than your actual principal, interest, taxes, and insurance payment. We can go down to a 1 where it makes sense. In a case like this, it makes sense. So it's a 1-for-1. As long as your rent meets your principal, interest, tax, and insurance payment, we're good.
Got it. And Troy, from a management perspective, you could look at this portfolio and you can look at it as 16 homes, right? You have a nice size portfolio here. What are some of the differences between managing that person that has one home and the person who has a small portfolio like 16 assets here in Richmond, Virginia?
Yeah, I think the biggest thing from an operations standpoint is customization from an operating perspective. When you have somebody with 16 properties like these, as we get them leased up, it's very easy to have them on our lease agreement. It's very easy for us to help them run numbers and come to an agreement. They know what they want to renew the residents at. They're a little bit more personally engaged in wanting to have those decisions. So there's not as much process as we need to follow on the back end. It fits more into, I would say, somebody between 1 and 20 homes probably fits into the same category with the involvement that they want to have. As you start to increase that with an owner with a larger portfolio, our back office gets customized down to a specific team that focuses on that portfolio or that owner as a whole. We create internal processes that fit with what they want to see as far as lease up, what leases look like, what our underwriting criteria even is for those residents that makes them more comfortable, whether that's the rules that they have to follow for their internal portfolio. Maybe we're just handling some of the tertiary markets, to if it's just their comfort level in general. Another big difference is the involvement that the owner wants to have. I think we may all know this, that somebody with 100 to 500 units doesn't want to be as involved in the day-to-day as somebody with maybe 1 to 20, making sure that the retirement fund or whatever it is operating correctly. The more private equity groups give you their parameters, and we build our team out to process those to make sure that it's working exactly the way that they want it.
Gotcha. And Michael, when you look at two different portfolios, right? You look at one in Phoenix, which was kind of the epicenter of SFR when everything kind of started running however many years ago, and then you go to a market like Richmond, Virginia. What's the key points of these different markets? Like what makes one market better for a newer investor as compared to somebody who might be a little bit more of a seasoned investor, within SFR?
Yeah, that's a good question, and I mean, there's probably a variety of answers. I think a market like Richmond right now is going to be a little more, geo focused. Like, you probably wouldn't get a Phoenix investor that would, maybe buy in Dallas or maybe buy in Vegas, probably buy in Richmond. But I think you're going to get both, that sort of 5, 10, 30, 100-mile radius investor around here, plus, investors coming from the Northeast, and maybe investors that are in Atlanta, they're in Memphis or Nashville that are starting to branch out, or Pittsburgh. and Richmond's a strong market, and it's getting a lot of eyes and has been really for I think the last 2 years. So we're seeing more activity come to the Richmond area, and I think we're going to see newer investors. Like Ted mentioned, he owns some multifamily deals, but we're seeing multifamily guys come into this SFR space, in almost every market. But I think this is a great opportunity for a multifamily guy to really dip his toe into the SFR space, because it's not too big. It's a 16 home portfolio. It's kind of at 3.8 million. It's that mid, kind of mid-tier investor, and we're getting interest from those groups, as well as some of the funds. This is a good, I'd say, sort of regional, local purchase for investors.
Absolutely. But why don't we go ahead and go ahead.
Question: we look at all the same metrics. Where are the jobs? What is the rent growth? What is the value growth? What is the opportunity? And then underwrite it from there.
Good stuff. Let's go ahead and flip over to the third and final portfolio. Go ahead and walk us through this one real quick, Michael.
Yeah, this is a unique one, and maybe this is one Ted should be offering on, since it's close to Gonzaga University. But this is it's a small 5-home portfolio rented by the bedroom to students. So this seller has aggregated all of these. I think he built one of them, lived in one of them. Him and his wife was their first home many years ago. But aggregated all of these. They're all contiguous. They're all, it's even ripe for redevelopment into multifamily, given the underlying zoning density here. But what they've been doing is renting to medical students and grad students by the bed. So every bedroom has its own lease with these students. So it's kind of a unique SFR portfolio, even for us, because they're all single-family detached homes. But it's kind of, or arguably, student housing in a great market in Spokane, Washington. And like Ted said, being close to a university is always huge, and this is only a block away, so they can walk, they can ride their bike, to Gonzaga. He's even got a lot of the tenants paying, some of the operating expenses, except for the real estate taxes and insurance. So he's done a good job of structuring these leases to make it a pretty simple investment for somebody that's looking to just take advantage of, the growth that's occurring here in Spokane, and taking advantage of just a never-ending slew of students to rent to, if they wanted to keep that sort of operating strategy going. And again, for those that are more real estate development focused, there's opportunity here to redevelop at some point in the future as well, and do some density multifamily, because they're all contiguous, and it really controls about a 50% of a city block with these houses.
Got it. That's interesting. Every time it pops up where Gonzaga is, I'm like, oh, is that where it's at? Because I usually only talk about them when it's the NCAA tournament and all that good stuff's going on, and I always get them in Valparaiso and all the other schools. I'm like, which one's where? And so
I'm glad I'm not
it's actually
alone.
a really. What's that?
So I'm glad I'm not alone there.
Absolutely. From an insurance perspective, Lee, are there any special challenges that somebody needs to work through when dealing specifically with like a student housing situation?
Yes. And so there's a lot of kind of, I don't want to say red flags, but there's a lot of things that need to be worked through on this portfolio. And we talked about it in the last portfolio as well. And Michael, I don't know if the current owner self-manages this portfolio or not, but the one thing I would say in a portfolio like this is property management is vital, and having good property management in place. And what I mean by that is, even if you self-manage your properties, to any investor out there, if you self-manage your properties, you are a property manager, okay? And it's very, very important from a risk management perspective to treat yourself just as you would Marketplace Homes as your manager. Have some distance between your management side and your entities that own the actual hard assets. So treat yourself as you would any third party. Put an agreement in place, make sure that there is some indemnification points towards the property manager preferably, and that if there's some sort of claim, that it really becomes more of a property management claim. Because in this situation, we're a little bit more worried about liability than we are the property side. Because when you hear students, now you said these are grad and medical students, which is a positive. They tend to have less keg parties, right? What's so vital here is that when you have a co-living situation, when you're renting something out by the bedroom, that you have good background checks in place, criminal, financial, sexual offender registry background checks, because you're throwing different folks into the same house, and you've got to be very, very careful. So from an insurance company perspective, they're going to ask a lot of questions about how you are screening and vetting these tenants, and so property management is the absolute key in this situation. The other thing about this portfolio and on the property side is they're older homes built in the late 1800s, early 1900s. Looks like they've been well kept and updated. Just we want to make sure that there's been updates to the roofs and the heating and air, the electric and the plumbing as well on these portfolios. But this one would be much more difficult to insure because of the way the houses are being rented out and the fact that they're students. Being grad and med students definitely helps.
Lee, could you comment on the liability of keg parties?
Yeah, well, when obviously, I mean, it's kind of, but underage drinking is a big thing, and even if you're not the landlord's obviously not sponsoring keggers, but in the event somebody were to be injured there, we see situations where anybody's having a party and we have too many people on a deck and the deck collapses and you have people, well, that's a liability claim. It's not excluded, but we want to try to have good risk management practices and minimize the opportunity for something like that to happen and for you as the landlord to get sued.
I was half kidding, but that I appreciate.
Yeah. Hey, yeah. Don't ask questions you're not ready for an insurance person's answer for.
And Alan, from a debt standpoint, when you deal with student housing, obviously you typically turn those tenants over a little bit more frequently. Would you guys be a little bit more conservative from a lending perspective on something like that?
Yeah, this creates a bit of a challenge. Whenever you're renting out rooms, it's definitely from a risk standpoint a lot riskier than your full your long-term rental for a single-family house, a family or something like that. So with these, we really got to dig in a little bit deeper as to how the lease is structured to truly understand what's going on. Is it one lease with everybody on the lease? Is it 4 individual leases? Ultimately, we don't want to see 4 individual leases. We'd like to see 1 lease with everybody on the lease, because then everybody's responsible for that total rental, right? So, we have to look at this one a little bit different. This one, obviously, debt service as well, but we'd have to dig a little bit deeper on those leases, how they're structured, because there is some risk to it. Sure. If we had 4 individual leases, we may have to reduce leverage to compensate for the risk. What was that, Mike?
Sorry to let you know that they do have longer term leases, and that the landlord even has the tenant's parents co-sign, but they're typically signing longer term leases because they know they're going to be there for more than just 1 year. They're, as I said, they're grad students and medical students, so right. they tend to hang around.
And we would take all that into consideration when making, underwriting decisions, but it does create a little bit more of a challenge just because it is individual leases. So therefore, you go from making $3,000 a month to $2,500 a month just by one person getting expelled from school for that kegger,
Yeah.
So.
And Troy, from a property management standpoint, I know you've seen a fair amount of college towns that we, not you personally, but maybe you have the typical owner that has that, the house that looks very similar to one of these. What have been some of the best practices that you've seen when it comes to renting in an environment like that?
I mean, one, from all the references to the keggers, I should have gone to Gonzaga because it sounds like a really, really fun time for what everybody else can say. But from a property management standpoint, having everybody on one lease is also a really good practice for us, I guess, internally as well. If we're going to stay on that topic, it creates a very simplistic way of managing the home. You make everybody responsible for the entire property. You can collect rent very easily from one person and kind of make it their job to collect the sub rent from everybody else in the home. It is a little bit more difficult because you do need to make sure your I's are dotted and your T's are crossed. Every time somebody revolves through the home, everybody has to sign a new lease as soon as one person's done with their classes, or they get expelled because of that kegger Alan was talking about. So that does create some operational challenges. However, what it does make it a little bit easier is the appreciation on the rent if these rooms are turning over, because you can, which typically we see every year, at least in our experience, every year one of the rooms is going vacant at least, and they're bringing somebody else in. You can raise rent on that room 25, 50 bucks, whatever it is, to slowly continue bringing the home up to market rent. Typically one resident's going to throw a fit if you try to make it more than $50, but if you split two residents who may have moved out, give them a $50 bump each, then you have $100 in rental increase from there. So I think there's pros and cons to this. I think the best way to do it though is obviously making sure everybody operates in one single lease. Makes it easier for us to collect rent, makes it a little bit easier for us to operate. And I think from an investor point of view, it makes it a little bit easier to make sure the property is performing at market level.
Yeah, and I think to Michael's point, about some of them being a little bit more longer term and whatnot, it's a give and a take, right? It's by doing it room by room, you're definitely going to maximize your cash position on the property, from a cash flow standpoint. While you might lose a couple of operational efficiencies, you pick it up on just being able to charge more per door, and you always have to get the parents to co-sign, no matter if they're grad students or medical students. So that's always a good idea.
If I could ask Ted, and Ted, I know you're a man of many things. I don't know if you're a developer or not, but given your proclivity to college towns and thinking about this from a land constrained environment, a good job growth, secondary market, how would you look at something like this, knowing that in the future, whether it's 5 years, 10 years, 15 years from now, this, whether it's a value appreciation and rent growth or a redevelopment into more dense urban housing, how do you look at an opportunity like this from an investor's point of view?
We always need to look at every investment, both in our entry strategy and our exit strategy. You should never buy anything without not knowing how you're going to sell it. And this one, from the sounds of it, you have that nice little twist that, we can redevelop it. And depending on what the planning and zoning restrictions are, everything. I do want to add one thing too, just while we were online talking about this, the other issue you want to talk about today are taxes, and no one's talked about taxes. And the Tax Foundation each year does a great big study. They look at all 50 states, look at corporate income tax, personal income tax, retail sales tax, unemployment tax, and property tax. Every one of these states is kind of in the sweet spot. The lowest ranked of the group, so the worst is Virginia, 26th. So it's about the middle of the country. You go to Arizona, 24th best. The property you're looking at right now is in the state that has the 16th lowest taxes to do business with and across the country based on those 5 taxes. So all of these properties are hitting that sweet spot. We need to talk about taxes too, but I'm going to go with you on this one. Whenever you buy anything, you got to think about your exit strategy. And this one has a nice little twist on that exit strategy. I can continue it as it is or redevelop potentially.
Yep. Yeah, multiple exit strategies. You got 5 separate homes. You can blade them, redevelop into density multifamily, or you can continue operating and increasing rents and value over time, as it's
Right.
extremely land. Yep.
Yeah.
Fantastic. That was great perspective. Quite frankly, all three of those portfolios, but the different way each one of you kind of touches the the property and the industry in general. So that was a really good discussion. I think there was one final poll question that was going to be pulled up. We can certainly do that now. In the meantime, if there are any questions, feel free to submit those. I know that there is we're running a little bit short on time here, and certainly if we can't get to those, we can take that offline and certainly have the appropriate person reach out to whomever might have the question. Do any of you guys have questions for anybody on the panel?
I personally do not, but happy to answer any questions. If anybody wants to email us over afterwards.
Yeah, absolutely. Appreciate the opportunity.
Like I say, really honored to be included amongst this group. I have a lot of respect for y'all. And I look forward to doing this in person next time. Let's do that again in person, because those are pretty killer.
Yeah.
I've done 41 plane flights this year already. So I'm ready to go wherever you guys want to meet, because I've been there probably. So let's do it.
That's outstanding. I know. Yeah. I think everybody on this panel is ready to get in front of people and shake hands and have our own keggers. I can understand that. All right. Well, guys, I certainly appreciate the time and the perspective that everybody was able to share today. Hope everyone that was joining us was able to get some great content, and feel free to reach out to anybody that was on the panel if there was a service or a portfolio or just some perspective to share within this great industry that we all love. Thanks so much.
Thank you, everybody.
Bye.